Okay, asset class returns in March. So what we've got here is the month-on-month returns in March and the year-over-year returns to 31 March. This is total returns USD terms unhedged. So where were the standouts? We've got treasuries at the top of the table, global sovereign close, well, a little bit behind. Cash did nothing, probably will do nothing for the foreseeable future. Obviously, in real terms, it's probably going to be a negative expected return there for cash, but of course, when everything else is doing this, then cash has, you know, that value of cash comes into play. So yeah, basically, aside from treasuries and global sovereign, everything else was negative. So yeah, tips, global aggregate, well, obviously credit got hammered. Credit got hammered for a couple of reasons there. So, yeah, obviously there's the direct sectoral impacts from the virus, the pandemic impact. So, travel, tourism, retail, those sectors coming under pressure because of that. And then, of course, we had the oil crash, a big black swan there in the black stuff. Oil crashed 40% when the OPEC Plus thing broke down and Saudi said they're just going to go for market share. Um, Truly catastrophic trading in crude oil this year. But of course, both US investment grade and high yield have about 10% exposure to energy. So of course, the energy sector there is definitely under pressure. And then the rest of credit, as you can tell, as you can probably see, um, the rest of the economy is not going particularly great either. So that's why that happened, and that's why everything else here has gotten hit. But of course, credit is a bit of a risk asset because of that risk component, but then it's still got that duration component, and it's still a little bit up the curve, or up the ladder from equities. And speaking of equities, everything got hammered, some more than others. Frontier markets, second from the bottom. US MLPs, I mean, obviously they're very, very much exposed to oil. REITs, a lot of damage there. I mean, anything that's exposed to the pandemic effects, so retail, um, hotels, short-term accommodation, obviously going to be taking a bit of a hit there. But even office stuff, there's probably a little bit of doubts or wondering about how many people are going to work from home in the future because they've had their first taste of working from home. Is it going to catalyze some trends that are already underway there? So yeah, and commodities obviously being very much directly impacted there. Emerging sovereign and emerging markets, just everything that's going on there. There's a bit of commodity sensitivity there as well. Yeah, that's basically the key highlights there. Treasuries up, everything else down. Year over year, it's a slightly different picture, but basically this echoing what's gone on in the month of March. I mean, yes, I already talked about what some of the drivers there or the sort of the notable developments. I mean, I think in March it became just abundantly evident that the pandemic is the base case, and lots progressively more countries adopting social distancing and self-isolation to deal with that, to try and flatten the curve. But other than that, again, there was that oil black swan, the crash in crude. But it wasn't all doom and gloom because they actually got a bit of a rebound in the last couple of weeks of the month, and that was basically, well, part of it. It might have just gone too far too fast, but then of course you had all the stimulus being announced. The Fed was just about daily announcing things, cut rates down to effectively zero, announced a massive new quantitative easing program and a whole zoo of credit facilities and other measures designed to just keep credit flowing and just kind of stop financial markets from seizing up. I mean, this is one thing that I've kind of thought about is that central bankers, policymakers, they actually had a pretty good practice run for this during the financial crisis, and now most of those guys who implemented and made those decisions back then are still in the seat, or at least their two ICs are, and they're able to quickly act and put these things into place to kind of mitigate the risk that this turns into some sort of depression. And of course, on the back of all those stimulus measures, how could markets not rally, especially when you've had valuations fall this much? On the data front, nothing much to talk about there really. I mean, it's going to be hard to really get any useful signals out of data over the coming months. I mean, China did actually rebound a little bit in their PMIs, and the rest of things starting to show, rest of the world starting to show the impact there, and things like consumer confidence PMIs. Other than that, I mean, looking forward, I guess it's a case of stimulus versus social distancing. How much the stimulus becomes, how much longer we carry on with social distancing. So that's kind of something that's going to play out in the short term. Valuation's going to play out more over the medium term. I mean, already we've seen substantial shifts in valuation. I've been talking about that a lot. And then other than that, I mean, I would say medium term are definitely bullish on valuations. Shorter term, there's just going to be this ongoing news flow, data flow, and the sentiment's still quite pessimistic. It's been quite a really regime shift in sentiment, so probably going to be the old phrase, more volatility and potentially more downside in the short term. Um, so I'll leave it there. If you've got any comments, questions, do feel free to get in touch or put them in the comments section below.